Is an employee stock ownership plan right for your business? Today, we're sitting down with an expert to cover everything from how they work to benefits for your business, like tax advantages and employee retention. You don't want to miss this episode. So join us on this edition of the Inside BS Show. Hey now, I'm Nikki G. This is the Inside BS Show, and we are talking all about ESOPs today. We're going to answer all of those questions that you have. I know you've heard about them, and you want to know more. Most of us don't really have a good understanding, so we're going to cover all of that with our guest. Before we do that, we're going to bring on my co-host, Dave Lorenzo. Dave, how are you?
Hey now, Nikki G. I am absolutely fantastic. I get asked at least once a week about an ESOP. And most people who ask me about it, candidly, they don't even know how to spell it. So there are so many misconceptions out there. Nobody knows what ESOP stands for. People don't know the benefits to their business. They don't know how much it costs to do one. They don't know why they should do it. But every entrepreneur that I know that has a business that's doing more than $10 million a year in revenue is curious about an ESOP. So we scoured the earth and we found the best possible person for us to talk to today. I am super excited to have this conversation. Nicola, when was the first time that ESOPs first came to the forefront of your mind? When did you like wake up in the morning and go, oh my gosh, I need to know what an ESOP is? Like, how did you first figure out that we needed to learn about ESOPs?
I think like most people sitting in our audience right now, you hear the term thrown around. So at some point I did, if you're in the business world, you've heard that term and you likely don't know what it means, and that's okay. So either you're curious and you start looking into it, or you just kind of wait for it to hit you, like right now with this episode. So that's when I first started, I am sure, and started really digging into it when you and I were working through, highlighting specific exit strategies that we thought our audience needed to know about.
Yeah, so for me, I did a talk at a Vistage group, and whenever you speak to an audience of Vistage business owners, you really are the veterinarian, because in that room is every breed of dog, cat, sheep, pig that you can possibly imagine. And it's not just different industries. It's all different levels of business ownership. There are people in there who have businesses that are doing like $2 million in annual revenue. And then there could be, normally it tops out at like 50 or maybe 60. So in this particular room, there was a gentleman, it was in Toledo, Ohio, and there was a gentleman who owned a construction company that was doing like $175 million a year in revenue. And I start the talk the way I start all talks, and I said, hey, how is this going to end for you? Why don't we go around the room and each of you tell me what your plan is for when you're ready to exit your business? And the construction company owner went last. And he said, well, Dave, I'm not really sure, but I need to do something sooner rather than later. And my financial advisor has mentioned an ESOP to me several times. I'm thinking it might be a good strategy. Dave, what do you think? And I'm standing there, and I basically looked at him, and I'm like, ESOP? Like the fables? Like the guy who, like the tortoise and the hare or whatever? And he's like, no, it's a specific plan. So that was when immediately during the break, I'm on my phone, like Googling, trying to figure out, this is before you and I were in ESL together, before we started this, I'm trying to figure out what an ESOP is. And I said to him, I'm honestly not an expert, so I can't give you advice on that. But anytime you start to think of a way to exit your business, it's a good thing, regardless of whether you're in your business from day one and you're thinking about an exit or you're starting to think about it today. So that was my way of kind of bridging the gap. And I immediately thought to myself, I need to go try and figure out what this is. And that's how we kind of drove ourselves to meeting our guest today. Once we started Exit Success Lab, we knew we needed to read up on ESOPs, and we got into them, and we knew for sure that we were never going to be the people to give advice to business owners who were thinking about using this strategy as an exit for their business. But the more I read about it, the more I realized that this not only would be a good strategy for someone long-term, it also serves as an excellent contingency option as well. So if you're joining us today and the question, what is an ESOP, has popped into your mind, or your financial advisor or your accountant has mentioned an ESOP to you, this is the show for you, because our guest today is Andrew Nikolai, and he is an expert in this area. This is what he does all day, every day. He lives and breathes the thing that we are so baffled by. So good morning, Andrew. Welcome to the show today. Thank you so much for agreeing to be here and to pull back the curtain on ESOPs for us.
Of course. I'm excited to be here today and talk about ESOPs. Thanks for having me.
Oh, no, thank you. And the first thing I want to ask you out of the gate is, are people as baffled as I am by this? Like when you go to a cocktail party and you say, listen, I help people plan for their financial future and I have specific knowledge of ESOPs, do they look at you and go, what is an ESOP? Is it just me, or is this a common thing?
No, it's everyone. So don't feel ashamed. Even just what the acronym stands for, we hear employee stock option plan. There's a lot of different words that get thrown out there. So just to be clear, we're talking about employee stock ownership plans. But yeah, it's very common. Like you guys both mentioned, ESOP gets thrown around there a lot, and people really don't understand what it is, how it works, and there's certainly a lot of misconceptions about it.
Let's start from the beginning, Andrew. Tell our audience what an ESOP is. Just give us the broad overview, and then we're going to dig into a few different areas.
Yeah, so an ESOP is an ERISA qualified type of retirement plan. So it's governed by similar rules like a 401k. We think about an ESOP as a tax advantage leverage buyout of someone's company. So ESOPs are unique in that it can borrow money to purchase equity from a business owner. So an ESOP, essentially functions like a tax advantage exit strategy where you're at the end of the day transferring ownership of the company to your employees through an employee stock ownership trust. So a trust is formed. That trust ultimately becomes the buyer of the equity in this transaction. And that trust, has a trustee that has a fiduciary obligation to the employees who are ultimately the beneficiaries of this trust.
So let's start from the beginning. When you say that ownership is transferred to the employees, when do you set up the ESOP? So if I'm a business owner and I'm maybe 10 years away from exiting, let's say, do I come to you when I'm 10 years away or 15 years away and I say, hey, listen, I want to make sure that my employees are involved in this business and that they're engaged for the long term. I want to think about what I'm going to do to give them some piece of ownership. How far in advance can you set it up? How far in advance should you set it up? And then I don't lose any control as a business owner, right?
That's right. Yeah. So it's always better to start sooner. I think a lot of times if a business owner waits too long, then it can actually eliminate an ESOP as a potential exit strategy, because at the end of the day, an ESOP is not a strategy where you can really walk away tomorrow and cash out, 100% of the value of your company. It's really typically a longer term strategy where you're exiting over a 5, 10, can even be a 15-year period. So certainly starting sooner is better. But it's a strategy that, has a lot of advantages. Certainly we're going to talk a lot about taxes today, because there are specific tax incentives built into the tax code to incentivize more employee ownership and more ESOP transactions. So we'll certainly get into all of those as well.
So Andrew, you have mentioned, the timeline for the exit itself can be a period of 5, 10, 15 years. How long does this process take to put the ESOP in?
Yeah, so I'll cut the process into 2 different stages. Stage 1 is typically called a feasibility analysis, and it's meant to determine, is an ESOP a feasible strategy for the business owner? That stage takes about 4 weeks to complete. It's typically based on, an initial set of financial information, and the goal is to model out all of the different transaction structures that are available, determine the valuation of the company, the financing options, and really lay out a comprehensive view of what's possible with an ESOP and if it is feasible. We'll sit down, go through that with a business owner for a few hours, talk through all the options, and if at that point it's something they want to move forward with, we're going to move on to stage 2, which is really a full ESOP transaction, bringing in all of the other parties that need to be involved, And that stage 2 process is typically more like a 6-month end-to-end process. So all in, you're looking at, I would say 5 to 7 months from stage 1 to stage 2 and closing a transaction.
Okay, and since you started with feasibility, I'd like to ask this. What type of company is best suited for an ESOP? Because I know it's not for every company out there. So what are you really looking at when you are doing the feasibility analysis?
Yeah, so we're looking at, does the company have, a management team and a significant number of employees in place that are going to be able to sort of operate the business? One thing to point out with an ESOP transaction is the internal team that's running the company today continues to run the company tomorrow. It is not a transaction where a new buyer comes in and is going to operate the business. So it's certainly important to make sure that there are operators in the business today that can run the business tomorrow post-transaction, especially if the business owner is planning to step back and be less involved post-transaction. So we're going to focus on that. We're going to look at the financials, make sure that from a financial perspective, they can support the cost of a transaction. They can support, if the owner wants to raise, debt financing, that the business can support that, and really making sure that, the company overall is ready to move forward with this transaction that can be, somewhat complicated. So we want to make sure the business has enough scale and size to support a transaction. Typically, we define that as being a minimum of 20 full-time employees and EBITDA or earnings of about $2 or $3 million at the low end.
That was the next question that I was going to ask, is what size business is needed in order to support this? So $2 or $3 million at the low end of EBITDA. And I would also imagine, and you can speak to this, and this is my question to you, do you need to be in a business or an industry that is relatively stable? So do you need to be in a business or an industry where there aren't a lot of peaks and valleys, where you have significant recurring revenue, where you have the ability to forecast a floor in earnings year over year, a floor in your EBITDA year over year? And the reason that I ask that is because I know there are specific, I think anyway, I shouldn't say I know, I think there are specific funding requirements for the trust. So, Andrew, speak to the need for a significant amount of predictable earnings and the reason why it's so important and the requirements that you need to keep up with every year when you enter into an ESOP.
Yeah, that's certainly something that we're going to look at and is an important part of making a transaction successful and feasible, particularly when, the ESOP trust that's coming in and buying the shares isn't bringing cash to the table. It's not a private equity firm that has money raised. So we're going out and raising debt financing most of the time to support a transaction. And that's really what provides the business owner cash at close. And so because of that, the banks are going to make sure that the company has a sustainable level of cash flow. They're going to be able to repay this debt going forward. And especially if the business owner wants to take more cash out up front, it becomes more important to look at the recurring nature of the revenue, the sustainability, and how predictable it is going forward. So that's certainly something that we kind of analyze and look into as part of that initial feasibility analysis.
And Andrew, I believe your background is in capital markets. And so for you, that financing piece, you've really been doing that before you moved into working with ESOPs. So I really want to ask you about when you were putting the financing in place, what are you looking at in terms of how you determine the amount of debt to finance? There's a valuation associated with this, right?
Yeah, that's right. So there's two different pieces. There's one, what's the value of the company, right? And that's based on a discounted cash flow analysis. It's based on looking at publicly traded companies in this industry, all of your traditional valuation methodologies, and that sets the value of the company. Then when we're going to go through an ESOP transaction, it's split up into how much of that value am I going to get in cash and how much am I going to get in the form of what's typically called a seller note. And so we need to look into both sides of the equation, first setting the value, and then if you want to move forward with an ESOP sale, how much of that consideration and value is going to come in the form of cash versus deferred consideration that ultimately is dependent on the future cash flows of the business to get that value out. So we work with many lenders that are familiar with ESOPs. We have pretty deep relationships across the country, so it allows us to run our clients and prospective clients by lenders who are going to finance these transactions and get a read from them on what they would be willing to do to support an ESOP transaction. And then we'll model it out, look into the covenant levels, look into the credit capacity of the company, the collateral that's available, and make sure that we're not putting the company in a tough position by putting too much debt on the business.
I was going to ask that. What's the loan secured by? What secures the loan? Is it a specific asset in the company? So, for example, if the company owns a building, or maybe the owner owns a building, is that what secures the loan? Or is it just the receivables that are coming into the business? How is the loan secured?
Yeah, generally the lender for an ESOP transaction is going to have a first lien on all of the company's assets. So that's going to include accounts receivable, inventory, if there's any hard assets like equipment or real estate. But a lot of times it can just be secured by the cash flows of the business. And so that goes back to what we're saying about the sustainability and recurring nature of it. With the construction company example that you mentioned earlier, the backlog and what's sort of built up going into a transaction, that helps support it. So it depends on each industry, but generally they're going to have a first lien position on all of the company's assets, and then also look into the cash flow, the contract structure of the business, and really get comfortable with what is the company going to produce going forward to repay this loan.
And when the business enters into the ESOP and the ESOP is set up, what is the communication like to the employees? They don't technically have ownership on day one, do they? And what percentage, how do you decide what percentage the employees are going to get?
Yeah, I'll quickly cover two misconceptions because we hear it a lot. One, people are concerned that employees are going to have access to sensitive financial information, which is generally not the case. If the business decides to share that, they can, but it's not a requirement of an ESOP transaction. Employees, technically are beneficial owners through the ESOP trust structure. So the second misconception is, I'm concerned, if I sell to an ESOP and to the employees, everyone's going to be rich tomorrow and they're all going to quit and leave the company. That, again, is not the case. The structure of the shares that are purchased by the ESOP go into what's called a suspense account. They sit there and generally get released over a long period of time, call it 25 to 30, can be as high as 50 years. And that structure is set up because this is meant to be a retirement benefit for the employees. It's something that's given out over a long period of time. And you also want to reserve shares for all of the future employees as the business grows and hires more people. When there's turnover, you need to keep some, dry powder, I'll call it, for those future employees. So initially, all the shares sit in the suspense account. There's going to be an annual allocation where shares get released to all the employees, and then each employee participates in that allocation, generally based on their compensation as a percentage of total company payroll.
And then Andrew, so we talked about the shares being essentially they sit until they're released over time. And what happens if an employee does leave the company? Can they get the share? Can they sell the shares? And what are the requirements there to be able to do it?
Yeah, so they're not allowed to take the shares with them. They have the right to put those shares back to the company, and the company makes them. Before they leave the company, they're building up value every year. They're going to have shares that go into their ESOP account. There's an updated share price, and so they're building up paper value. When you retire, if you're terminated, when you decide to leave the company, that's when you convert that value into cash. And there's certain restrictions the company can set up front when they're designing the ESOP plan in how that cash is paid, whether it's over a 5 or 6 year period, if it's immediate. So they do have the right to cash those in once they leave the company.
And something you also touched on, Andrew, was like who continues to run the company so the management stays in place. Because I think there's another misnomer that I want to ask about, which is that people think the employees now have a say in how the company is run because they have an ownership interest. So talk to us about that a little bit.
Yeah, that's right. So generally post ESOP, the board of directors is the one that's going to be running the company and making all of the operational decisions. There is really no change in the employee's ability to influence, hiring and firing decisions other than what it was pre-transaction. It continues post-transaction, but it's not like all of a sudden, if you sell to an ESOP, your employees can come the next day and say, we're firing you. That's not how it works. A lot of our clients actually choose to go the path of an ESOP because of that retained control aspect, because we have clients that are worried about their legacy. Maybe their name is on the door or on the name of the company, and they want to make sure that they're protecting that legacy going forward. So an ESOP transaction is a way to monetize your equity, get some chips off the table, and diversify your wealth, but still maintain control of the company that you've built over time and really make sure you're protecting the management team and the employees.
All right, so let's look at a couple of scenarios, and then we can talk about taxes. We can talk about we can talk about when you get all the money from the ESOP, and does the owner have to exit, or can he or she continue to run the company? But first, let's talk about something this is like the first question that I get asked all the time about an ESOP. So I'm in an industry, Dave, where private equity is buying up everybody. If I do an ESOP and private equity comes along, am I going to be less attractive? And that's my client asking Dave a question voice, just so you know. So Andrew, what is the answer to that? If you're in an industry where private equity is gobbling everybody up and you have an ESOP in place, what happens?
Yeah, I mean, we help our clients that have previously sold to an ESOP do some sort of third-party sale every year. It's certainly still possible. I think one of the misconceptions that makes people think it's going to be harder to be sold in the future post-ESOP is, the ownership structure and what we talked about, where the private equity firm isn't going to come in and have to convince every employee to sell their shares to them, right? You're dealing with the top level entity, which is the trustee, who has the fiduciary obligation to make decisions that are beneficial for all of the employees. So if a private equity firm comes and says, we want to acquire the business for twice the price that you paid when you bought the shares from the business owner, that's a good deal, and the trustee has an obligation to consider it. And most of the time, if they have the option to convert the value of privately held equity in this business to cash and put that cash in all of the employees' pockets, that's something that they're going to consider and a lot of times decide that's a good deal for us and we should take it on behalf of the employees.
So does the ESOP own the business the minute it's set up? Because the way you're talking, it seems like ownership has already transferred.
Technically, the trust is the legal owner of all the shares that the ESOP acquires, but the shares are sitting in that suspense account and start to get released out to all the employees slowly over time. But all the shares are legally owned by the trust. But it also depends on the structure of the transaction, right? Maybe you only sold 30% to the ESOP. This is not an all or nothing type of deal. You can sell 30, 49, 75. There's lots of different options. So it depends on what the initial structure was.
And you get paid when you make that transaction. So if I'm setting up the ESOP 15 years before my ultimate exit and I say the ESOP's going to own 30% of the company, you guys, I'm sure, do a valuation, and you can tell us what the process is for that. You do a valuation, you determine the company's worth X, and then you go out and borrow the money to pay me the 30%. So I get that 30% right now, yes? Is that how that works?
That's right. Yep, exactly.
How is the valuation done? Explain to the folks who are watching and listening how the valuation is done.
Yeah, so you hit on one of the misconceptions earlier that, if I want to sell to an ESOP, I have to be willing to sell at a discount or take a discount to what I would otherwise get on the market. And generally, that's not what we see. There are even some industries that maybe you can get a little bit more, but especially when you consider some of the tax advantages that we'll get into and look at things on an after-tax basis. So we're going to be running a valuation just like a prospective private equity acquirer would be. You're running a discounted cash flow analysis. You're looking at precedent transactions in the industry, publicly traded companies, and using sort of a blended approach of those different methodologies to come up with what's called a fair market value for the company. So all of those approaches lead to this valuation. It is a negotiation that we have to do with the trustee, who also is hiring their own valuation advisor and expert who does the valuation on their side, and then we sort of trade back and forth and end up somewhere in the middle. I would say, relative to a strategic buyer who is willing to pay a higher price for the synergies that they're going to recognize, then yes, we will admit that an ESOP is going to be a discount to that. But relative to a private equity or other financial buyer, I think you're going to see valuations pretty similar between those different transactions.
So you mentioned that ESOPs can really vary in terms of the percentage that you're going to have as the ownership in the trust, anywhere from it could be 30 to even 100. I mean, it could be a full amount. So I think that's a great place to start with tax benefits. So tell us, and I think that's probably the top tax advantage that we think about when we are considering ESOPs. So tell us about some of the tax advantages.
Yeah, so I'll start with the first tax advantage that's really to the selling business owner, and it's called Section 1042. If any of the listeners are familiar with Section 1031 in real estate, which allows you to sell a building and roll over the gain into a like-kind property, 1042 is not too far away in the tax code, and it operates very similarly, but it's specifically designed for ESOP transactions. So when you sell your business to an ESOP, subject to certain requirements and reinvestment requirements, you can defer and potentially eliminate the capital gains taxes on that sale to the ESOP. So that becomes an extremely powerful benefit, especially for business owners that live in New York City, California, other high tax jurisdictions, where you're going to lose, 30, 40% in any other transaction. With an ESOP, that can be brought down to zero. So some of the requirements to be eligible for 1042 are: one, you have to have held the stock for at least 3 years. The company has to be a C corporation at the time of the transaction, and the ESOP has to own at least 30%. So that's generally why we use 30% as the low end when you're considering an ESOP transaction. There's no requirement to take advantage of the 1042 benefit, but it does provide a significant benefit when you look at it on an after-tax basis relative to other transactions.
And so that's really a personal benefit to the owner. So, and there's corporate benefits on the tax side as well, right?
Yeah, that's right. So most of our clients eventually want to get to 100% ESOP-owned S corporation, because under that structure, you can actually operate 100% tax-free from federal and most state income taxes, which is a really powerful benefit into perpetuity. You can be making $1 million a year or $10 million a year. It doesn't matter. You don't pay taxes on it. So that is a really powerful benefit that ultimately helps to, like we were talking about before, repaying debt from a transaction. All of the tax savings, right now, if you're structured as an LLC or an S corp and you're personally taxable for all the income of the company, that immediately goes to zero. All of those tax savings and cash flow is freed up to then repay the debt from the transaction and pay out the business owner from the transaction. So that becomes a really powerful corporate benefit. And that's under the S corp structure. If the company is a C corp and is taxable at the corporate level, there's also a sort of a bucket of tax deductions that are created from the ESOP, and that can be used to shield your taxable income going forward. So under a C corp structure, you're probably going to be looking at a 10 or 15% effective tax rate after you factor in all of the deductions with the ESOP transaction.
Okay, wow, that's significant. So at the S corp level, we can have up to 100% tax-free operations, state and federal level. And then the C corp, we have significant tax benefits as well. I just wanted to highlight that because that is very, very significant.
How does the control of the business work if the ESOP is the 100% owner of the business? Does the trustee then call the shots? How does that work, Andrew?
Yeah, that's a good question. The trustee really comes in as a passive investor. They don't want to make operational decisions because that's not what's good for the employees. They know that the founder, the management team, the people that are running the business today are the ones that are best suited to run the business tomorrow. And if they do something to impact that or change that, it can actually negatively impact the employees and the beneficiaries of this transaction. So the trustee will sometimes require certain corporate governance measures that be agreed on or negotiated as part of a transaction. That can look like setting up a board of directors with one or two independent board members. It can look like a compensation or an audit committee being set up to handle certain measures like that. But generally, the ESOP trustee is not sitting on the board of directors. They don't want to sit on it. Any operational decisions like hiring, firing, bonuses, all of that sort of stuff is handled by the board of directors like it is today. And the trustee will get involved for more major decisions like you want to sell a division of the company, you want to make an acquisition, larger scale decisions like that are then going to require, bringing in the trustee, having them review it and sign off on it. But other than that, the trustee really comes in as a passive investor. They want to look out for their fiduciary obligation to the employees and to make sure that things go well for them.
Now, I have a question about something that triggers an automatic purchase by the ESOP. Is there something where if an offer is made and the ESOP is in a better position that sale is automatically triggered? I don't know where I heard it. I don't even know if it's a thing, but do you have any idea what I'm talking about?
There can be something called event protection, which is really an automatic acceleration of shares that get released and allocated to employees. There's never going to be an automatic, acceptance of a purchase or a sale because the trustee wants the right to review the terms of the transaction at that time. And it's hard to say now if the price in the future is the right price or is considered fair. So there is something, though, where shares may be accelerated and given out to employees faster. It's sort of like an accelerated vesting schedule where, the employees would receive more in a transaction if the company gets sold in the future.
Andrew, are there specific trustees for just ESOPs? Because I know in certain spaces there are. That's all they do. So tell us a little bit about the trustees who serve in this capacity.
Yeah, that's right. Most of the trust companies that we work with have specifically been set up for ESOP transactions. So there's a group of, call it 5 to 7 trustees across the U.S. that we work with. A lot of times they're former attorneys or maybe former CFOs, individuals that have some sort of prior ESOP experience that have gone out and kind of set up a trust company or set up a shop on their own. And they're exclusively set up to negotiate ESOP transactions and serve in that trust capacity. So their role is to negotiate the terms of the transaction on behalf of the employees. And so they hire their own counsel for every transaction. They hire their own valuation expert for each transaction and rely on those advisors' expertise to help them determine what is fair market value and what are a set of legal documents and terms that will be a good deal for the employees.
And that makes sense because there's also a high level of regulation and compliance associated with these ESOPs. I mean, you mentioned when we started that, it's an employee benefit plan. So talk to us a little bit about that. I mean, about the structure associated with that, because there is that compliance component.
So all ESOP transactions are governed by the Department of Labor, by the IRS. There are certainly landmines to avoid and a lot of sort of guardrails in place to protect the employees. The Department of Labor is primarily concerned about the trustee in these transactions paying too much because it'll disadvantage the employees post-transaction. So there are certain restrictions and rules in place, and it's very important to make sure that you're working with advisors and counsel individuals that are aware of these. There is flexibility within those guardrails as well, but there are things to avoid. We also work with third-party administrators who can help run compliance testing and help with the bookkeeping to make sure that we don't run into any issues there.
And especially post-transaction, kind of who's really driving that ship, making sure that we are remaining in compliance with the laws that apply.
Yeah, so I think it's important that things are set up initially in terms of designing the ESOP plan. So, for example, vesting schedules for employees in terms of how they vest in their shares. There are things that are allowed and things that aren't. So it's first about designing things up front that don't immediately, cause any issues. But then also, the trustees are certainly involved in looking out to make sure that nothing changes post-transaction that would cause issues. And then you have that extra layer of the third-party administrator who has very detailed software testing. They're going to look at the allocation schedules by employees and really make sure that there are no compliance issues. And if something does come up, work with the company and their counsel to, restructure things a little bit to avoid that issue.
So, Andrew, does everyone get the same amount of shares, or can I say, okay, my management team gets this amount of shares, and the truck drivers get this amount of shares, and the people who work in the warehouse get this amount of shares? Can you portion out who gets what shares, and are all the shares weighted the same? Is there any preferred stock versus common stock? How does that work?
Yeah, so there's two primary options to set up initially. At a high level, the ESOP has to be done on a non-discretionary basis, meaning you can't pick and choose certain individuals that are going to get more than the other. You set up a set of rules, and all the shares get allocated out to employees based on those rules. So the most common and first approach we'll talk about is based on compensation. So everyone's payroll as a percentage of total company payroll is the percentage of shares that they'll get through the ESOP. So the person making $100,000 gets twice as many shares as the person making $50,000. So automatically, you have more shares going to generally the people that are more important are the ones making more money in the company. So you automatically have that disparity between employees. The other main option is to set up some sort of point system where you can give credit for years of service and other certain attributes where you sort of set up a formula. And so now instead of compensation, you're taking other, maybe qualitative factors into account and allocating shares that way again. But there are rules in place to make sure that the lower level employees that are making less aren't disadvantaged through these plans. So a lot of times what we do as part of an ESOP transaction is set up an additional management incentive plan that allows you to pick and choose if there are other employees who you want to get more. You already have some disparity in the ESOP, but you can set up something like a stock appreciation right plan where then you can pick and choose these 3 people or these 5 people are most important to me. And so we're going to give them a little bit extra to make sure that they're incentivized to, run the business and make sure it performs.
So if I already have people in my company and I've said these 3 people are key employees, and when I was doing $5 million in revenue and $2 million in EBITDA, I decided I was going to take 5% of the company and break it up among these 3 people, or 6%, break it up among these 3 people, give them 2% each. Now I'm going to set up the ESOP. They're just treated just like I am as other owners, and can they participate in the ESOP as well as have that percentage of ownership? And can I, as the owner, also participate in the ESOP?
Yeah, so the main restriction on participating in the ESOP is going back to that Section 1042 capital gains deferral benefit that we talked about. If you take advantage of that benefit, then you and your family are excluded from participating in the ESOP. So you're going to get that capital gains benefit, and instead you're not able to participate. If you don't take advantage of it, then you are eligible and can participate in the ESOP. So that's typically how it works. But if you have equity outside of the ESOP, you can also get more shares through the ESOP. That's not a problem.
And I just want to put a fine point on this because I want to make sure it's clear for our audience. So all the employees have to share in it once it is established. And from there, we can have some variation or disparity in additional participation, whether that's from management or key employees or others.
That's very common for our clients to want to have, everyone in the ESOP get something, but then give the people that are sitting at the top and are really going to be running the business going forward to have a little extra to make sure that they're incentivized.
That's great. And then a lot of what you highlighted really is suggesting that these are highly customized plans. So talk to us a little bit about that, because I don't think this is a cookie cutter situation with any ESOP plan that you're handling.
It's something that makes it interesting and exciting. Every client we work with is a different situation, so it certainly doesn't get boring or mundane, but it's also very complicated. Just like we talked about up front, you could sell 30%, 100%, or anywhere in between. There are structures to include warrants, these management incentive plans that we talked about. So it's certainly very important to look at what all the options are, try and work with the business owner up front to figure out what they're trying to achieve and what their objectives are, and then designing the structure around what they're trying to achieve. Because an ESOP is so flexible, it provides, virtually infinite amount of options. And so it's really, about that upfront work to narrow down what options make the most sense and align with what the business owner is trying to achieve.
So, Andrew, what does it cost to set this up initially? Because that's the thing we hear. I would love to do it, but there's a cost associated with setting it up. And then there are costs every year, and the trust has to be funded. I mean, I get all kinds of nervous Nellies complaining about this stuff. And most of the time, they don't know what they're talking about. So you do know what you're talking about because this is your deal. What does it cost to set up? What does it cost every year? Tell me about funding the trust. And I know that everything is customized, blah, 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 but give me the minimum, like the minimum for each level.
Yeah, I would say generally we tell anyone who's interested in understanding what an ESOP would look like and what the costs are to at least move forward with that stage one analysis. Because it's so dependent on the structure and how complicated things are, the size of the business, all of those details, we will typically outline all of the costs involved with the potential ESOP transaction as part of that stage one feasibility analysis. Typically, that upfront feasibility analysis is going to cost, $5, $10, maybe $15,000. So the idea is, the cost is kept relatively low up front to unlock, what does an ESOP look like? What are the costs involved? If you decide you want to move forward with an ESOP transaction, generally all in the costs are going to, range, but I would say start around, a few $100,000 at a minimum and scale up from there, depending on the complexity, depending on the structure, depending on the capital raise portion and what that looks like. So there is certainly an upfront cost, but I think it's also important to really see the full feasibility analysis to understand what are the benefits. Because if you're going to save, $5 million in capital gains taxes, have a business that operates 100% tax-free going forward and saves, $100 million in corporate taxes, well, maybe the $500,000 or $1 million investment upfront to do the deal is a pretty good return when you consider it, with all of those other benefits.
What about maintenance on an annual basis? Is there a percentage of the ownership or a percentage? Like, how does the maintenance every year work?
Yeah, so there's 3 parties that will be involved and will continue to get paid on an annual basis. First, you have the third-party administrator who's responsible for doing all of the back-end bookkeeping, administration, and compliance testing with an ESOP transaction. I would roughly say they're going to, charge about $10,000 a year. Next, you have the ESOP trustee and their valuation advisor. They stay involved on an annual basis going forward because they have to update the valuation and the share price so that when employees get their statement that says you own this many shares, they need to also know what the price per share is. So the trustee and their valuation advisor, I would roughly think about them on an annual basis costing probably $40,000, maybe $50,000 a year. So all in, I would say $40,000 or $50,000 on an annual basis is really the ongoing maintenance costs.
Okay, you said there were 3, so the trustee and the valuation advisor are 2 and 3, and the administrator is number 1. Okay, great. So you're talking about, $50,000, $60,000 in annual costs, and you're talking about $500,000 to $1 million to set up, but you're going to save a ton of money in taxes, and that's the way to look at it. And if you're saving that money in taxes year after year after year, that's how it ends up paying off for you in the long run. Does size of the business have an impact on the fees to set it up and the administrative fees going forward, or are those administrative fees pretty boilerplate? They just have to do what they have to do every year, whether you're a $10 million business or a $100 million business?
Yeah. I would say maybe they scale up a little bit, the administrative fees. So, 50 to 75 for a higher business, but, they're generally pretty steady. The cost up front may be a little bit more. It also depends on if there's any sort of corporate reorganization that needs to take place. So we have some clients that come to us and they have 10 different, entities that all need to be rolled up in a tax efficient manner so that they can all be sold to the ESOP. So things like that. If there needs to be some sort of conversion to a C Corp or an S Corp, all of that is taken into account when we think about the fees. And then also the capital raise and the financing portion of it, how complicated that will be, how aggressive does the business owner want to get. All of those sort of details are factored in when we think about the upfront cost.
And what happens if the owner dies? The ESOP is set up and the owner still, let's say we do a 49-51 ESOP. And the 51 is the owner, the ESOP owns 49%. And the owner gets hit by a truck and he dies before anything, before he's ready to exit. How is that handled with an ESOP in place?
Yeah, the nice thing about having done the ESOP prior is you already have set up a buyer that can essentially acquire more equity at any point in the future. So, you've already set a valuation on the business. It's going to be updated on an annual basis, so you know pretty much what you're going to get for that 51%. It's subject to negotiation, of course, but you've already kind of put in place a plan for future exit opportunities and for future sales in the future, and it can be done in a relatively streamlined and efficient manner because all of that due diligence information and all of that work was done up front. So the second sale is typically streamlined and more efficient. The other thing I would briefly point out is there are a lot of estate planning opportunities as well. When you think about doing a minority sale of 30 or 49% initially, a lot of our clients will take advantage immediately post-transaction of the lower valuation of the company because of the transaction debt that was placed on the balance sheet, and use that temporary reduction in value to move, in this example, the 51% into a trust or into some sort of other vehicle that is now outside of their estate. So if you do pass away before you monetize that value, a lot of times you've already avoided the estate taxes that would come with it.
Yeah, that's a great idea. I love that.
Andrew, I wanted to ask just briefly about the maintenance fees. Are those governed by statute or is it just like standard in the industry?
Yeah, it's based on, a fair market, what trustees and valuation advisors are looking to charge and be paid for the work that they're doing on an ongoing basis. So generally, in order to update that valuation and that price per share every year, they need to look into how did the company perform last year, what are the expectations for the future, and essentially do the same valuation work that they did for the upfront transaction. So there will be conversations with management, a briefer due diligence process, but there is some work that they'll need to do in order to refresh the numbers and the valuation. And so it's sort of just defined by what they're looking to be paid for that work.
When people decide they don't want to do this, what are they telling you their reasons are? If they, besides money, let's take that off the table. Cheapskates aren't going to do this. But if they're eligible, they meet all the criteria, what is the reasoning? Why do they say no?
I think a lot of times it's because people are looking to exit sooner. They want to walk away tomorrow or the next day. They're burnt out. They're looking for someone to come in and take over the operations. And the ESOP is really not that. We've talked about how the management team and the board is going to keep running the business. And so that's most common, I would say, is when you're ready to retire tomorrow. An ESOP generally isn't going to be the best fit unless you have a really strong management team that's already running the day-to-day and it'll allow you to step back.
I mean, on that point, Andrew, what's generally the owner's involvement once it's in place?
Yeah, it's generally decided by them. If they want to step back and just be chairman of the board and have, quarterly or monthly board meetings and be updated somewhat regularly, and they trust the team that's in place and running the business, that is certainly an option. If they want to be the CEO, continue to take a salary and continue to, really run most of the operational decisions, that's also an option. I would say we do have a number of clients that are young, think 40 years old. They're proactively thinking about an exit strategy. So maybe they start with a 30% sale, but they still want to work for the next 10, 15, 20 years. And that's certainly possible, but they're setting up a plan in place to sort of exit over that time period and over that horizon.
Andrew, tell us a little bit about your firm Tell us what you guys do all day, and then let's talk about how people can get in touch with you if they want help with something along these lines.
So CSG Partners is a boutique investment bank that's based in New York City. We've been around for 25 years now and have done over 350 ESOPs over that time. So we're one of the most active financial advisors in the country. We have a nationwide practice. We work in all different industries, but ESOPs are really all that we do. If we work with a business owner and they decide they want to go through a traditional private equity sale or third-party sale, most of the time we're going to step aside and say, you can probably find someone better to help you with that transaction. We go very deep and really specialize in ESOPs, the tax benefits, how to structure them, how to raise the financing for them, and really how to, optimize the outcome for the business owner.
Tell us, when should business owners contact you?
Yeah, I think it's always worth at least getting that stage 1 analysis done. We've had some clients that will do that, come back, 5-10 years later and say, okay, I'm ready to do it now. But at least they got that information and could make, informed decisions about it going forward. We're not going to sit here and say every single business owner should do an ESOP or it's always going to be the right fit. But at least as you're considering your options and what strategies may be the right fit, you should look into and at least do that initial analysis to see the full outcome of an ESOP transaction. And then you can compare it to your other options and make an informed decision.
So I want to recap for everyone who's listening and watching what people should be thinking about when they are getting ready to call you. So the EBITDA threshold, you said we probably should look at like 3 million and up in EBITDA because there's going to need to be kind of a tax justification for setting this up. 3 million in EBITDA is the dollar threshold you mentioned. I think you also mentioned a number of employees threshold. What was that again, Andrew?
Yeah, I would say 20 full-time employees.
20 full-time employees, that's when it makes sense there. And then the upfront analysis that you and your team will do, you gave us a range, let's call it $15,000. That's what you plan on spending, at least $15,000 to get that upfront analysis done. And what that is for you is that's going to be your guide as to whether or not it makes sense. And even if you don't decide to do the ESOP now, you've got the peace of mind. You paid $15,000 for an education to understand the potential tax benefits of doing the ESOP. Then you can plan on spending a minimum of around $300,000 to set up the ESOP. Bigger, more complicated ESOP planning ventures are going to scale up. So anywhere from $300,000 to $1 million is the setup. And then you're talking about $60,000, $70,000 a year every year in administrative fees. But you don't lose any control. You immediately will get some type of a windfall once the company is sold because they're going to get a loan that's going to pay you some money. And every year you're going to participate in tax savings that will way more than offset these expenses. So the question is, do you have the wherewithal up front to get this set up and make all of this happen? That's why there's an EBITDA threshold of 3 million or more. 20 employees or more. I'm sure that has to do with government regulations and all of that sort of thing. So, Andrew, as we look at this whole thing and we look at the entire ESOP spectrum, when owners are making this decision and they don't have a sale to somebody else on the horizon, this is a really good contingency plan. Like you said, if the owner gets hit by a bus or somebody in their family gets sick and they decide they need to take care of them, immediately there's a trigger to go ahead and sell. I'm assuming that the valuation, because you mentioned there's a fee every year, valuation is done every year, so we know what the stock price is every year. So if I wake up on a Tuesday morning and I decide I'm out, I can be out at any time.
Yeah, it'll take a little bit of time to document it, but certainly you at least have an annual, sense of what, the rest of your equity would be worth. And, we have some clients that say, all right, I'm going to do a 30% sale today, diversify my wealth, put this option in place in the future, and maybe in 5, 10, some years down the line, I plan to sell the business to a third party, and that will allow the employees to at least participate in that sale, and get 30% of the proceeds at that time. And that'll be really my ultimate exit and where I cash out the rest of it. So there's always a range of options, but it doesn't preclude any future transactions if you decide you want to do a minority sale today.
So how long is your setup period in a moderately complicated? So not the easiest, but not the worst. How long is your setup period in the upfront?
Yeah, I think I would roughly say plan for 6 months to complete an ESOP transaction. And a lot of that is defined on, how has the business been prepared? Are they ready to go through a transaction? Do they need to get some sort of quality of earnings or reviewed financials or something done up front? That's going to add time to the front end of a transaction before we can really start moving forward with it. So if the business is ready and has prepared some of that already, think about a 6-month process start to end.
All right, Andrew, tell us how people can contact you if they'd like to have a conversation about an ESOP, whether it's right now, it's imminent, or it's down the road.
Yeah, so our website is CSG Partners. We are here to be ESOP experts. We want to be, and we are talking about ESOPs every day. So whether you have questions about it, just want educational resources, want more detail on anything we've discussed today, you can find, my information. It's Nikolai@csgpartners.com is my email address, but our entire team is listed on our website. You can reach out to any of us, and we're here to help people understand ESOPs and figure out, is it the right fit for you?
All righty. Thank you, Andrew Nikolai from CSG Partners. That is fantastic information. It has been wonderful speaking with you about this. You covered every question that we had, and we really appreciate it. If you want to reach out to Andrew, his contact information is down in the show notes. If for some reason you want to ask us a question, we will probably pull Andrew in and get him on a conference call, so you can call him directly, reach out to him with the information down below. An ESOP is an option for you if you have a business with 20 employees or more, are doing more than $3 million in EBITDA, and you want to take some chips off the table in the short term and continue to run your business, continue to live your life the way you're living it with just a little bit more money. An ESOP might be a good fit for you. We are incredibly grateful to Andrew Nikolai for spending the last hour with us. It has been an honor to have him here. This is the Inside BS Show. We're here every day with a show at 6 a.m. every week with a brand new interview for you. I am Dave Lorenzo, the godfather of growth, and she is
Nikki G.
Until next time, here's hoping you make a great living and live a great life. Thanks for listening to this edition of the Inside BS Show. My name is Dave Lorenzo. If you'd like to apply to be a part of our community, please join us by completing your application directly with me on the phone. You can call me at 786-436-1986, 786-436-1986. I can't wait to speak with you. Join us by calling me today.